Hey everyone, and welcome to this explainer. I am seriously so excited to have you here today because we're going to completely transform how you look at market charts. Honestly, if you've ever opened up a trading platform and just felt totally overwhelmed by a chaotic mess of lines, squiggles, and flashing numbers, well, you're in the right place. Today we're taking a super structured, clear, and highly focused approach to building a professional trading toolkit from the ground up, and we're only going to use the absolute most proven technical indicators. But before we get to the charts, we got to talk about a pretty harsh reality. 69%. Yep, according to broker data, 69% of retail spread bettors and CFD traders actually lose money. That is a massive number, and honestly, it instantly bursts that whole bubble of easy overnight profits that so many people are sold online. The truth is, most beginners step into the markets completely unprepared. They use the exact same indicators as everyone else, sure, but they use them incorrectly, and that leads straight to this staggering failure rate.
So listen to this really brilliant quote from SEC market professional Zishan Akram Malik. He says, "An indicator is just a tool. What actually gives profit is market structure understanding, risk management, session timing, and discipline." We're going to lean heavily into this toolkit metaphor throughout the explainer. I really want you to remember that indicators are not magic crystal balls that somehow predict the future. They're just specific tools, and they require a skilled craftsman to actually wield them properly.
All right, so here is our blueprint for today to get you trading like a true craftsman. 1. The trading toolkit reality. 2. Spotting the overall trend. 3. Measuring momentum and volatility. 4. Uncovering volume and hidden support. 5. Building your trading system. And finally, 6. We'll cap it off with the golden rules.
Okay, Section 1. The Trading Toolkit Reality. Look, before we even touch a mathematical formula or chart pattern, we absolutely have to get our mindset right. Think about building a house for a second. You wouldn't use a hammer to cut wood, right? It sounds ridiculous, but this is exactly what amateur traders do every single day. This causes what we like to call indicator paralysis. They take a tool designed for a trending market, apply it to a ranging sideways market, and then they sit there wondering why they just lost money. You must only pull out the specific tool you need for the exact market condition you're facing. Matching the tool to the environment, that's literally the entire secret to indicator success.
Moving right along, Section 2, Spotting the Overall Trend.
So, with that reality check out of the way, you really need to know which way the wind is blowing before you set sail, right? Enter the moving average. This is basically the ultimate compass for a trader. You know the markets are noisy. Prices are just constantly spiking up and down minute by minute based on news, random trades, and algorithmic bots. Well, a moving average mathematically smooths out all that chaotic price data over a specific period to reveal the true underlying path of the market. It basically tells you immediately if you should be looking to buy or looking to sell.
Now, there isn't just one type of moving average out there. We have the simple moving average, or SMA, which weights all time periods equally. It's definitely smoother, but it's much slower to react to sudden market changes. Then we have the exponential moving average, or EMA. The EMA places a heavier mathematical weight on the most recent prices. So the really crucial takeaway here is that because the EMA reacts much faster to what the market is doing right now, it is overwhelmingly the go-to choice for active traders who need responsive signals.
Okay, let's look at a highly actionable way to actually use this stuff. It's called the Golden Cross Strategy. Step 1. You plot the 50-period EMA. That represents your medium-term trend, and the 200-period EMA, which is your long-term trend. Step 2, you just patiently wait for the 50 EMA to cross right above the 200 EMA. Step 3, boom, you have your golden cross. This is a massive structural buy signal. Once this happens, you want to look to enter bullish trades, specifically on pullbacks to the moving average, using it as a sort of dynamic support.
But hang on, how do we know if a trend is actually strong enough to trade in the first place? Well, that's where the average directional index, or ADX, comes in. Unlike a moving average that shows you direction, the ADX specifically measures the pure strength of a trend. Readings above 40 indicate a very strong, healthy trend, while a reading below 20 tells you the market is weak and just ranging. This brilliantly illustrates how we can use one tool to find the direction and another tool entirely to verify if the trend is actually worth following.
All right, Section 3, Measuring Momentum and Volatility. So now that we've got our compass, we need to check our engine. We need the tools that tell us how fast the market is moving and when it might actually be running out of gas. Our primary tool here is the Relative Strength Index, or RSI.
Think of the RSI kind of like a warning light on your car's dashboard. It oscillates between 0 and 100, comparing the magnitude of recent gains against recent losses. When the price moves way too far, way too fast, this indicator flashes a warning that the market is overextended, meaning it might be due for a reversal or a pullback.
Now, to use the RSI like an actual pro, you need to follow some strict best practices. Stick to the standard 14-period setting. Traditionally, a reading above 70 means the market is overbought, and below 30 means oversold. But please, listen carefully here. An overbought signal does absolutely not instantly mean sell in a strong uptrend. Seriously, the RSI can stay overextended for a really long time. It actually works best in ranging markets. What you really want to look for is divergence. That's when the price makes a new high, but the RSI makes a lower high. That right there is your dashboard warning light blinking bright red.
Next up in our momentum toolkit is the wonderfully versatile MACD. The MACD essentially bridges the gap between spotting a trend and measuring its momentum. It literally takes two moving averages, the 12 and 26-period EMAs, and subtracts them to create a momentum oscillator. When the MACD line crosses its signal line or crosses the zero line, it gives you this incredibly clear visual confirmation that momentum is shifting from the bears to the bulls or vice versa.
So what about volatility? For that, we use Bollinger Bands. Bollinger Bands basically measure the standard deviation of price. But the most powerful setup here is something called the Bollinger Squeeze. Step 1, you wait for the bands to narrow significantly. This indicates very low volatility. The market is basically coiling up like a spring. Step 2, you wait for the price to aggressively break out of those bands. Step 3, you enter right in the direction of that breakout. The expansion of the bands confirms that a massive, explosive move is underway.
Okay, Section 4. Volume and hidden support. We're going to shift gears a bit and focus on the blueprint of the market, revealing hidden support levels and tracking what the institutional smart money is really up to. One of the absolute most fascinating tools in technical analysis is the Fibonacci retracement. When a market is trending, it almost never moves in a straight line, right? It pulls back. Well, the Fibonacci tool draws this hidden structural blueprint over your chart based on a naturally occurring mathematical sequence. It essentially gives you a roadmap pointing out the exact horizontal levels where a pullback is most likely to end so the original trend can resume.
Let's see how this actually builds our entry strategy. Here are your key Fibonacci levels. You've got the 23.6% shallow retracement, all the way down to the 78.6% deep retracement. But I really want to draw your attention specifically to the 61.8% level. This is known as the golden ratio. In trading, the 61.8% retracement is widely considered the ultimate sweet spot. It provides the most reliable, highest probability entry zones when the market pulls back.
Section 5. Building your trading system.
All right, we've explored our individual tools, and now we're at the most crucial step, synthesis. We're going to combine these tools to build your trading system, but we're going to do it without creating a messy, unreadable workspace. The golden rule of building a system is simplicity. The ultimate rookie mistake is slapping 5 different trend indicators on a single chart. Honestly, this just causes lagging, conflicting signals and total confusion. The professional best practice is to use complementary indicators. So you combine one trend indicator, like your moving average, to find the direction, with one momentum indicator, like the RSI, to pinpoint your entry. You want your tools to verify each other, absolutely not repeat each other.
And you know what? The data backs this up perfectly. This brilliant survey from Pakistani market professionals shows exactly what the real traders are actually relying on day to day. 42% favor the moving average, 27% use the RSI, and 18% rely on the MACD. This absolutely proves that professionals aren't out there chasing the shiny, complex, exotic new indicators you see advertised all over social media. They are relying heavily on a select few, foundational, complementary tools to find their edge.
All right, bringing us to Section 6, the golden rules.
Let's distill everything we've talked about into the core realities of using technical analysis. It's all about balance here. The pros of technical indicators are super clear. They're accessible for beginners, and they provide excellent visual confirmation to keep your strategy objective. But hey, the cons are equally real. Indicators are, by their very nature, lagging because they're built on past price data. They can absolutely generate false signals during volatile news events, and worst of all, they can cause a really dangerous overdependence. Never ever forget, price action and market structure must always come first. The indicator is just there to confirm what the price is already telling you.
I want to leave you with a really profound thought to ponder today. If 69% of retail traders are out there losing money, and almost all of them have access to the exact same moving averages, RSIs, and MACDs that you do, is your true trading edge actually found on the charts?
Or is the ultimate tool your own psychology, your risk management, and your unbreakable discipline? Mastering the charts is just step one. Mastering yourself? That's how you actually win the game. Thanks so much for joining me on this explainer.